A room of 12 unelected people met last month. No votes, no public debate, and in 45 minutes, they moved the price of Bitcoin by thousands of dollars. Most people don't even know this meeting happened, and that ignorance is costing retail investors money every single cycle. This is the Federal Reserve. And whether you hold Bitcoin, gold, or nothing at all, every financial decision you make is being shaped by what happens inside that room. Here's what nobody tells retail investors. Most people think Bitcoin is decentralized, free from governments, free from banks. And technically, they're right. Nobody controls the Bitcoin network. But here's the question I want you to hold in your mind for the next 8 minutes. If Bitcoin is truly free from control, why does it crash every single time this one institution raises interest rates? And why does it explode every time they cut? The answer will change how you look at every market forever. But first, you need to understand what the Federal Reserve actually is. The Federal Reserve, called the Fed, is the central bank of the United States. Created in 1913, it has one job above everything else: control the flow of money through the US economy. Think of the economy like a car engine. Sometimes it overheats. That's inflation. Prices rising too fast. Money losing value. The Fed's job is to cool it down. Other times the engine stalls. That's recession. Economy slowing. Jobs disappearing. Growth collapsing. The Fed's job is to restart it. They do this with one primary tool: interest rates. Remember the question I asked at the start? Why does Bitcoin crash when the Fed raises rates, even though nobody controls Bitcoin? We're about to answer that right now. And once you understand this mechanism, you'll never look at a Bitcoin chart the same way again. When the Fed raises interest rates, borrowing money becomes expensive. Businesses borrow less. People spend less. Economy slows down. Inflation cools. But risk assets, stocks, crypto, everything speculative, they get sold. Because suddenly, keeping money in a safe bank account paying 5% looks far more attractive than holding volatile Bitcoin. When the Fed cuts interest rates, borrowing becomes cheap. Money flows freely. Businesses expand. People invest. And that money needs somewhere to go. It flows into risk assets. Stocks go up. And Bitcoin, the ultimate risk asset, goes up even more. This is the mechanism. This is why the Fed controls Bitcoin without ever touching it. And here's where it gets specific, because I want you to understand exactly how to use this information. In March 2020, the Fed cut rates to zero, emergency level. They also started printing money at a scale never seen in history. $4 trillion injected into the financial system in 12 months. Where did that money go? Everywhere. Stocks, real estate, and Bitcoin, which went from $8,500 in March 2020 to $69,000 in November 2021. A 700% gain in 20 months. That wasn't luck. That wasn't a chart pattern. That was liquidity. Fed created liquidity flowing directly into risk assets. Then, in March 2022, the Fed flipped. Inflation had reached 9%, the highest in 40 years. They started raising rates aggressively, fastest rate hiking cycle since the 1980s. By late 2022, rates had gone from 0 to 4.5%. What happened to Bitcoin? It crashed from $69,000 to $15,500, a 77% collapse. Not because Bitcoin's technology changed, not because adoption slowed, but because the Fed tightened the money supply and risk assets got absolutely destroyed. Same pattern, every single cycle, without exception. Now here's what most retail investors get completely wrong. They watch Bitcoin price charts obsessively. Candlesticks, RSI, moving averages. And they miss the single most important input, what the Fed is actually doing. Before you look at any Bitcoin chart, Ask 3 questions first. Question 1. What is the current Fed interest rate? If rates are above 4% and rising, be cautious. High rates mean expensive borrowing, tight liquidity, risk assets under pressure. If rates are below 3% and falling, conditions are becoming favorable for Bitcoin. Question 2. What is the Fed signaling about future rate decisions? They release statements after every meeting, 8 meetings per year. Every statement contains clues about where rates are heading. Words like restrictive mean tighter conditions ahead. Words like accommodative mean easier conditions ahead. These words move markets billions of dollars in seconds. Question 3. What is happening to the M2 money supply? The Fed publishes M2 data monthly. M2 measures the total amount of money circulating in the economy. When M2 expands, liquidity is growing, more money chasing assets, Bitcoin goes up. When M2 contracts, liquidity shrinks, money leaves risk assets, Bitcoin suffers. Study this number every single month. Now here is the situation in 2026. And this is the most important part of this entire video. The Fed has been cutting rates since late 2024. After a brutal hiking cycle that peaked at 5.5%, they have now cut rates multiple times. The money supply is expanding again. Global liquidity is returning to the system. At the same time, the dollar index we covered in a previous video, the DXY, has been weakening significantly. A weaker dollar means more global purchasing power for Bitcoin, more buyers, more demand. And layered on top of all of this, the April 2024 Bitcoin halving already happened. Supply of new Bitcoin cut in half. Miner sell pressure reduced overnight. 3 macro forces, all aligned simultaneously in 2026. Rate cuts expanding liquidity, dollar weakening increasing global demand, post-halving supply shock reducing sell pressure. The last time all 3 of these forces aligned together was 2020. You already know exactly what happened to Bitcoin between 2020 and 2021. History doesn't repeat exactly. Markets evolve. Institutional participation is different. Regulatory environment has changed. But the macro mechanics, liquidity, rates, dollar, supply, those mechanics are timeless. And right now in 2026, those mechanics are aligned more favorably for Bitcoin than at any point since the last cycle. Here is how to track the Fed yourself, for free, starting today. Go to federalreserve.gov, bookmark it. They publish every interest rate decision the same day it happens. They also publish the FOMC meeting schedule for the entire year. Mark every single meeting date in your calendar right now. Those 8 dates per year are the most important dates in all of financial markets. Second, search Fed funds, rate historical chart on any financial website. Study the 2020 to 2024 period alongside a Bitcoin chart. Lay them on top of each other. You will immediately see the relationship with your own eyes. No analysis required. The pattern speaks for itself. Third, every time the Fed meets, watch what happens to Bitcoin in the following 48 hours. Do this consistently for 3 months. You will develop a macro instinct that puts you ahead of 90% of retail investors who are still just watching candlestick charts. To summarize, the Federal Reserve controls the flow of money through the global economy. When they create easy money conditions, risk assets, including Bitcoin, thrive. When they tighten, risk assets, including Bitcoin, suffer. This is the documented, repeatable pattern of every Bitcoin cycle since 2013. The 3 questions before any Bitcoin decision. What is the current rate? What is the Fed signaling? What is M2 doing? Right now in 2026, all 3 are moving in Bitcoin's favor. On this channel, every week, I track the Fed, the DXY, gold, and Bitcoin together. So you always have the macro picture before the crowd does. If this is the kind of analysis you've been missing, subscribe. And if you haven't watched our DXY video yet, watch it next. It connects directly to everything we covered today and gives you the second piece of this macro framework. See you next week.